Welcome and thank you for watching this webinar. My name is Liz Barton and I am head of the corporate team at Doyle Clayton. Joining me on this webinar is Roger Holman, who is a tax advisor at Mark Davies Associates. Contact details for both of us are available at the end of this webinar. Now, the reason we're here today is to talk about selling a business. This is quite a rare thing for most people. It may only happen once in your lifetime and can involve significant amounts of money, so it's really key to get it right. Roger, when your clients start talking to you about selling up, what's the first thing that you ask?
Hi Liz. Well, the first thing we need to think about is what they're actually selling. So let's assume for a start we're selling a company. Then we have to look at actually what is the buyer buying? Are they going to be buying the shares of the company, so the actual company itself and everything that's inside that, or are they just buying the business and its assets and leaving anything nasty behind inside the company? Now, from a tax perspective, there's a very big difference between buying the shares or buying the assets. But that's just the tax side. There's also, as you know, a huge difference from a legal side of things.
That's right. Although the process is similar, there are important distinctions between the two. So first of all, I'll just try and explain a little bit more about the difference between a share sale or a company sale, we use those terms interchangeably, or a business or asset sale. And the way I like to try and do this is using my shopping basket analogy. So as a seller, if I am selling the whole company, I am giving to the buyer the entire shopping basket. They take the basket, which represents the company, together with all of the contents, whatever may be in that basket. So they've got all of the good items on the top, but together with all any rotten apples that might be hidden away at the bottom that they don't necessarily know about. So I hand over the entire basket, warts and all. If we're selling the business and the assets instead, as the seller, as holding the company, I keep the company, and instead I take all the individual assets out of the basket, and the buyer can pick and choose what it wants to buy. So when the buyer gets to the bottom of the basket and sees the rotten apples down there, it can say, no, I'll leave those behind, and they can pick and choose a lot more about what they want to buy. So I keep the company and the assets come out of it, as in the contents of the basket come out of it. So that's a bit of an analogy to try and explain the difference between the two types of sale. But Roger, as you mentioned a minute ago, actually tax is really important, and it is one of the main factors in deciding whether a seller proceeds with a share sale or a business sale. So perhaps you can just give a little bit more information about that.
Yeah, I mean, it is massively important, and the difference can be huge. But like all of these things, I never like to have tax being the main driver in any of these business decisions. You know, the last thing we want to do is scupper a really good buyer coming along and saying, I want to buy this company or business, just because we're saying, well, it doesn't work for us on the tax side of things. That said, you can actually make it work either way from a tax side. But the first thing is really to look at what you want to do with the money. If you want to go on your world cruise, spend all your money wining and dining, and end up with nothing in your bank account when you come to the end of your days, then actually the very best thing is to have a big cash lump sum at the start of that sale process. The best way to get that from your perspective is to sell the shares of the company. If you sell the shares of a company, you're going to pay capital gains tax on that profit that you make on the shares. You're going to get what used to be entrepreneur's relief, most likely, on that. So that will reduce the tax rate for part of those proceeds down to £1 million, 10%. Now, that entrepreneurs relief has actually changed its name. It's now called business asset disposal relief, or BAD relief. And that's because actually a couple of years ago, the government changed the rules. So instead of being £10 million of relief, you only get £1 million of relief. So it's not really as valuable as it used to be. Now, that's the simple case of selling the shares. Selling the business of the company itself is going to pay corporation tax on the profit that it makes within the company. And that's going to be taxed at 19%. Obviously, that tax rate is going up over the next few years. And then if you want to take the money out at a later date, you can either pay yourself dividends over the next few years, paying income tax on those dividends, or you can wind up the company, liquidate it, and pay capital gains tax on the balance that's left inside the company. So effectively, it's almost like paying tax twice on those proceeds. That sounds really bad, and it sounds like no one would ever want to do that. Why would you want to do that? It's a crazy idea. But actually, what you can do is, if you don't want to go on those world cruises and spend every single penny, and you want to actually invest those proceeds, you can keep that money inside the company. Now, if you're going to buy things like shares in Shell or other companies, then any dividends that they pay to the company are going to be tax-free. So you can see that actually, if you're going to invest the proceeds of the sale, sometimes it's actually better to have it inside a corporate environment, because instead of paying 38% on personal dividends, you're paying 0% on corporate dividends. So it's a much, much better way to handle those long-term investments, but there are other tax consequences of it. You know, as we said, the choice for what you're selling is massively important from a tax perspective. It's not always your own choice. Sometimes it does come down to, you know, if the buyer will only buy the assets, then you're stuck with that. If the buyer actually wants the shares because they want to keep that name and everything that goes along with having that company, it's their decision. So it's not always your own decision. Obviously, it always comes down to the deal itself and what the lawyers can do and negotiate. And that's always a difficult thing to understand. And, you know, understanding how the sales process goes is where people like Liz come in.
Thank you, Roger. Yes, let's focus now a little bit on that sale process in that case. So before we get into the nitty-gritty, there's a couple of early stage matters that must be dealt with first of all by the actual sellers. So first thing is get your advisors in place. You will need advisors, you will need lawyers. As we've hopefully demonstrated already, we strongly recommend that you do also use tax advisors, especially at the start of the process, to guide you on the overall structure. Your business's accountants are also usually used very early on during the process, because actually they're going to have an important role in helping you agree the purchase price and valuing your business. So the next stage, or whichever order you choose to do this in, is actually to get the other shareholders and the directors on board with agreeing with the sale. You don't want any of the other shareholders to disrupt the process by refusing to sell their shares. So getting them on board early is really useful. And the director's help will probably also be needed in answering the various questions that are going to be raised by the buyer during the course of the process. So once you've got all the people around you, the next stage is hopefully then to agree some general terms with the buyer. So the particular terms at this stage are likely to comprise structure, which we've just talked about. Are you going to sell the shares, or are you just going to sell the business? You'll also be talking about price, obviously very important, and maybe payment terms. Now, all of these key terms are often written down in a set of heads of terms. These are also known as heads of agreement, letter of intent, memorandum of understanding. There's all sorts of different names, but they're all basically the same document, which is just a simple document which sets out the main terms that have been agreed between the two parties. And lawyers aren't necessarily even involved in getting that document together. And as such, that's not a legally binding document. It doesn't commit anyone to go ahead. It's just effectively a reference point on which the later documents are based. So then the next big stage that actually happens for when you're selling your business is for the buyer to conduct its due diligence. And this is where the buyer tries to find out, I guess, the headline issues about what it is actually trying to buy.
Liz,
yes, sorry.
You always talk about due diligence, and all the lawyers I've ever dealt with when dealing with the process of selling a company talk about due diligence. And it's one of those things that obviously as a tax advisor, I sit there nodding very knowledgeably in meetings about selling companies when you guys talk about, oh, you've got to get your due diligence sorted. But can you kind of explain a bit more about what it actually is? Because it's a funny word, you know, due diligence. It can mean anything really, can't it?
Let me try and clarify. Yes, don't ask me about the source of the phrase due diligence, but yes, let me try and clarify the process. So due diligence is the main chance, as I say, for the buyer to find out more detail about what it's actually buying before it commits to the next level of costs with their advisors on actually drafting the paperwork. The process also actually allows the buyer to verify that the business is worth what they've offered to pay. So it's worth being aware that it is possible that the buyer might try to chip away at the price if anything unexpected comes up in their due diligence, if they then think actually maybe they're overpaying because of these issues. Due diligence usually involves detailed financial due diligence. Their accountants are going to be involved in reviewing all of your accounts and your management accounts. They're also going to take a closer look at all other matters relevant to the business and the industry in which it operates. They're going to be looking, for example, at key contracts, all your staffing matters, the property that you occupy and you run the business out of, anything and everything. So in anticipation of this, due diligence process can actually be a really good opportunity for you to carry out a full review or legal audit of your business. Call it getting your house in order. If I take that phrase literally, before you sell a house, you're usually going to fix any obvious repairs, maybe paint the walls. I might have to paint this wall when I come to moving out. Whether anyone would want to buy this, I don't know. You have to trim the garden, perhaps. Now, the same is true for your business. Is everything as it should be? Do you have signed employment contracts in place for all of your staff? Has that key customer still not actually signed their contract and got it back to you? Will you finally get around to actually repairing that particular piece of equipment? All these points are very likely to come out of the woodwork during a buyer's due diligence exercise, so it's best to be prepared. Whether you want to have lawyers involved at this stage is entirely up to you. Of course, doing so will increase your costs. And as no one knows your business better than you, most of this work can actually be handled in-house. Does that answer your question, Roger?
Yeah, it does. And actually, it brings me on to a point about when someone's thinking about selling the business. So, you know, if you're at the stage of you haven't really gone to market yet, you're thinking about selling your business, you're starting this due diligence process, your internal record checking, making sure everything's right. Actually, at that point is really when you should be getting tax advisors involved. I would say that because I'm a tax advisor. But realistically, what you want to be looking at there is whether the business is structured right for a sale. So again, kind of coming back to that first point I was making about whether you're selling the business or the shares, here you can look at restructuring the business in a in a better way that makes it more packageable for buyers to say, actually, you know, maybe you're trading out of premises that you own personally and you want to get that structured better from a tax perspective. At that point, you can do it. If you're way down the process of a deal already been structured and, oh, I suppose we better get the tax advisors in, it's kind of too late to get the tax advisors in then. You really want to do it before you've even gone to market. So I think at this point of doing your own sort of personal due diligence is the best time to then think about, oh, is there a good thing that we can do from a tax advisor perspective to get that business in the best way so that you can maximize that overall return and minimize those tax costs. The other thing that always crops up in my head when, or crops up on a number of deals, is when you're looking at the due diligence side of things and there's little tax skeletons in the cupboard. You know, perhaps you've implemented an EBT to do some share options arrangements with the employees, and often that's an absolutely normal way to run a company. But the minute a buyer hears the word employee benefit trust, they think of all the bad things that are associated with the employee benefit trusts. So if you can clear up some of those bad things before you start that sale process again, it can really help smooth the way through.
I completely agree. And as you say, all these things, the existence of an employee benefit trust and all these things are going to come out in the due diligence anyway. So if, you know, this information is all going to end up going to the buyers. So if you can sort things out before you get to that stage, if you're thinking of selling, get this prep work done first. It's absolutely invaluable. I would completely agree with you on that. But having said that, when you do get to the due diligence stage, there are two things I think I would really flag up as really, really important when you're getting there. Before you hand over any information about your business to the buyer, especially if they're a competitor, please make sure that you have a signed confidentiality agreement in place. That way, if the deal were to fall through, or even if it doesn't, but you know, there's a delay, but you don't want the buyer being able to use any of the information that you've given them, which may be your trading terms, it may be details of your customers and your database. If they, with the confidentiality agreement in place, if they do then use that information for a purpose they're not supposed to use it for, you have at least got grounds to sue them or try and get an injunction or do something to protect your position. The second thing, when you're providing this information to the buyers, is to keep really good track of all the information that's being provided. Ideally, all documents should be provided probably through an online data room these days. There are loads of providers out there, and if necessary, your advisors will probably have recommendations for their favourite service provider. But it's important to note that you do get what you pay for. There are free services out there. I think things like Dropbox and things through Google, they're free. But with a paid-for service, you have much better organisation of the contents of the data room, and we'll come back to why that's important later. But you can actually also put clever extra tricks in there as well. So you can restrict the visibility of certain documents to certain people at the buyer. So you may want the accounts only to be seen by their financial guys or something like that, and not just, you know, anyone else, or maybe only their accountants or something like that. So you can restrict visibility of documents. You can stop them printing documents out if you want to, if you don't want them to have hard copies lying around, or if you are happy for them to print documents out, you can, for example, ensure that there are watermarks printed out in every case, which can confirm your ownership of those documents. So all of these options come with using a sort of professional paid-for data room provider. So it is definitely something that we recommend. Having that little bit of extra cost up front can pay dividends in the long run. So that's, I think, everything I've got to say about due diligence, unless you've got any other questions, Roger. So
I'll leave you on that, Liz.
So hopefully by this stage, we've got the main terms of the sale agreed, the due diligence has been completed, and everybody still wants to go ahead. So what is next? Well, next is actually documenting the transaction. I'm afraid this can be quite a paper-heavy exercise, but on the plus side, most of the documents, or the first drafts of the documents, are at least prepared by the buyers and the buyers' lawyers rather than the sellers. The first main document that we're going to come across is the actual sale agreement itself. It sets out all of the agreed terms, so price, payment terms. So are you getting all of your money in cash upfront at completion? Are you maybe receiving some money on deferred terms over a period of time? Is some of the purchase price going to be paid by giving you shares in the buyer? Are you going to earn some of the money over a period of time? So, for example, is part of the price dependent on the performance of the business after completion? We call this an earn-out. It's usually only used where the seller is going to have some kind of ongoing involvement after completion. Now, before I go any further, Roger, I'm very aware, are there any tax issues that we need to think about if the purchase price is paid in over a period of time, whether it's earned out over time or just paid in installments?
Yeah, I mean, the basic position is you need to work out what your overall price is going to be. Once you know that figure, you then have to pay tax on that figure. Now, from a seller's perspective, ideally you get that all in cash up front and everyone's happy, you can walk away and you can pay your tax on time with no worries. That very rarely happens in reality because the buyer obviously is buying something that's not 100% certain over how it's going to perform over the next little while. So there's often, as you say, some kind of earn-out period or deferred consideration based on number of customers that stay or number of profits or whatever it ends up being. That deferred payment also has to be calculated up front and you pay tax on that up front. It used to be the case that we would say, right, okay, let's look at this deferred payment. We're getting all this payment for the shares in the business. We're going to get entrepreneurs relief on the full payment. So let's estimate it on the high side of what we're going to receive on the basis that we're going to pay 10% tax on that gain rather than 20% if you have to pay tax later on that deferred payment. That's what we used to do because we had £10 million of entrepreneurs relief to play with. That's now obviously restricted to just £1 million, which is still a lot of money, but it's a lot less of a figure than obviously 10 million. So now what we will tend to do is if the proceeds are going to be over that million figure, we'll try and restrict what we estimate that deferred payment to be. You're never going to come to a position where you know exactly what it's going to be up front. So if you estimate it around about the right figure, then you're fine. On the other hand, if you estimate it to be £2 million and you actually end up receiving 8 million, the revenue are going to question your original estimate because, you know, that was clearly completely wrong and you may end up paying quite a lot of interest, and maybe even a bit of penalties on that tax that you've underestimated. So while we'll try and estimate it on the low side, it's got to be estimated on the low reasonable side. But the point is you're going to have to pay tax on the full consideration upfront rather than when you necessarily receive the proceeds.
Thank you. I knew there was a point to note there, so thank you for clarifying that. So picking up where I left off in that case, so we were talking about the main terms of the sale agreement. In addition to the price and the payment terms, You may also find that there are restrictions on the sellers. Now, these would be designed to prevent you from competing with your old business for a period of time afterwards. Now, the reasoning behind this is to ensure the buyer gets the full value of the business it's bought. The last thing the buyer is going to want you to do is, as soon as you sold the business, to set up an identical business in competition with them, and all your customers go and follow you to that new business, because suddenly what they've got really isn't worth very much. There may also be some indemnities in the agreement. Now, indemnities are circumstances where the seller is required to meet specific costs after completion for particular liabilities that might have come to light during the due diligence process. So, for example, if there could be, that there's been identified some kind of tax penalty or something like that, that Roger's, well, not exactly the type that Roger's just suggested, but because they come later. But if there is some kind of penalties, or there's some litigation anticipated or something like that, the buyer may well say, you know what, you need to take the hit on that anyway, regardless. So we're going to recover that from you anyway, even though we know about it. One of the main indemnity points that's covered, especially on a share sale, is in relation to tax. In particular, I'm not going to go into the details of tax indemnities on this webinar. That could be probably a whole separate webinar on itself. But the situation is basically, if, for example, the sellers have taken out a load of profits before completion, but the tax hasn't yet been paid on those profits, then it's probably only fair that actually the sellers do bear the cost of that tax, having taken the benefit of the profits. So it's a bit of a levelling up after completion, just to ensure a fair balance of liability and responsibility for tax between the buyer and the seller. There are also going to be a number of warranties in the sale agreement. Now, warranties are basic contractual promises. The buyer will usually include a schedule in the main sale agreement, which can easily be 10, 20, maybe even 50+ pages long, depending on the complexity of the deal and the value of the business. Now, this schedule sets out a number of statements relating to all aspects of the business. For example, there'll be warranties as to the accuracy of the accounts. There'll be warranties that all contracts which are material to the business have been provided to the buyer. There'll be probably warranties that the sale isn't going to cause any suppliers or customers to stop dealing with the business. There'll be warranties that there's no litigation or claims affecting the business. Maybe that all the assets used in the business are all owned by the company. So they cover all aspects of the business. And if any of those statements turn out not to be true, the buyer may have a claim against the seller for breach of warranty and may be entitled to be refunded some of the purchase price. It's therefore really important to ensure that the sale agreement includes limitations on a seller's liability under the warranties. And this is usually at very least in terms of financial caps, and time limits for when claims can be made.
So with the warranties,
yes.
Sorry,
yes.
with the warranties, when do they actually, when does that come to light, and how does so normally it's, the seller is going to end up paying some money because something's gone wrong somewhere. So is that money often held on escrow, or is it just part of the deferred payment proceeds that we were talking about earlier? How does that work, and how does all the litigation around something going wrong end up coming out?
Okay, to a large extent it depends on negotiating positions between the parties, so no two deals are ever going to be exactly the same. If an issue comes to light which the buyer decides is actually a breach of the warranty, there's no disclosure, we'll come to that in a minute, but there's no explanation from the sellers as to what this is all about, and there does seem to be a breach of the warranty is not true. The buyer will notify the seller that it has a claim under there. If the seller resists it, this could then go to court to be resolved by the courts as to whether there is a liability there and how much that liability is. It may be that the seller holds their hands up and go, no, you're right, I've forgotten about that. I should have told you. You're absolutely right. I agree. You do have a valid claim, and I agree the amount of the claim is X, Y, Z. So that then determines, you've got to a stage either by agreement or through the courts as to how much is potentially owed to the buyer. And in calculating all this, we take into account all the limitations that have been agreed and the restrictions that have been agreed in the sale process. So ideally, there is a cap on the overall liability. So the seller should never be liable for, at the very worst case scenario, should never be liable for more than they've actually received for the business, so that the buyer doesn't make a profit out of this. Where that money then comes from in order to pay up, again, now that comes down to a negotiating position between the parties. For the seller, the usual best case scenario is that they've had all of their money up front and they're sitting in their own bank accounts to spend as they will. However, that means that if there is a warranty claim, the sellers then have to dig in their own pockets and find that money. So if it's all been spent, that can cause issues as to trying to then work out how you're going to pay the buyer or repay the buyer some of the money that is then due to them. If there are elements of concern, depending on the bargaining power of the parties, there may have been an agreed escrow arrangement. So this is where some of the purchase price is held by a neutral party, usually one or both sets of solicitors, for a period of time, an agreed period of time, maybe 2 years, or no more than 2 years, 1 or 2 years, so that if a claim is made, the buyer knows that there is a ready pot of money it can dip into to take to be reimbursed for the claim. The seller also has a certain level of comfort that it doesn't have to dig into its own pockets. There is a pool of money sitting there to meet those liabilities. And if there is no claim at the end of the escrow period, that money is paid on to the seller in the end anyway. So it is totally really a bargaining position between the parties. Does that answer your question, Roger? Have I covered that?
Yeah, no, that was good. Thanks, Liz. It's one of those, another one of those weird dark arts of the lawyers that tax advisors, we try and scoot around that sort of thing to just pass it back over to you guys in the law. That's
what we're here for. But I did mention when I was talking about that just now, I did use the term disclosures. Now, disclosure, let me talk a little bit about that, because that is actually the second main document that is used and negotiated in the sale transaction. This is called a disclosure letter. And disclosure is a really important process because it's one by which the seller can formally notify the buyer of any facts that make any of the warranties untrue or misleading. So, for example, going back to one of my earlier examples of the warranties, I mentioned that there's probably going to be a warranty that all of the assets that are used in the business are actually owned by the company. Now, what happens if some of those assets are actually leased? Maybe they're on a hire purchase arrangement. They're not owned in the usual sense by the company. So therefore, the seller will make a formal disclosure in the disclosure letter to state that actually some of the assets are in fact leased. Disclosures should usually be full and fair, and they need to provide sufficient detail for the buyer to identify the nature and extent of the matter of concern. So you can't just say some of the assets are leased. You need to be more detailed than that. And we usually do this by way of a mixture of narrative in the disclosure letter itself and also cross-referencing to documents that are in the data room. So that goes back again to when I said earlier about why it's so important to have a well-organized data room. So you can then clearly refer back to, for example, a copy of the lease agreement that's sitting in the data room. The buyer then buys the business or the company in full knowledge of all of those disclosed matters and cannot bring a claim against the seller in respect of those matters which have been fully and fairly disclosed. So this is a really important level of protection for the seller. There will be duplication between the information provided at the earlier due diligence stage and that covered by the warranties. The warranties will probably also go a step further, and additional documents may need to be provided which have not previously been considered. Partly that's because the lawyers have definitely got involved by this stage and have thought of more things or raised more issues. I totally appreciate that this can be very frustrating, but it's not sufficient to simply say that the buyer is aware of a particular matter because you've discussed it with them offline, over the phone. We need to go through this full formal disclosure process and ensure all those discussions are therefore documented and referred to or repeated in the disclosure letter. And your solicitor will be able to guide you through that, will know the sorts of things to look out for. So that's a bit of a potted summary of the disclosure letter, and those that with the sale agreement are the main two documents which take the most effort and the most work. There are loads of other documents that are needed to complete a sale, most of which do need to be signed by the sellers. These include stock transfer forms if you're selling shares, but also board minutes, directors' resignation letters, company's house forms, and lots of other bits and pieces as well. I'm not proposing to spend any more time discussing these documents in any detail because they're not usually controversial. They're a bit of a formality and can be agreed very quickly between the parties' lawyers in the run-up to completion, so at the end of the process. There are also lots of other considerations which we don't have time to cover here. Although there is one final point I would like to flag up, which is particularly relevant when selling a business or assets, because this type of sale will result in a change of employer of your staff. They'll go from being employed by a seller company to being employed by a buyer company. Now, there are regulations which exist to protect these employees. They're known as TUPE, T-U-P-E, which stands for the Transfer of Undertakings Protection of Employment Regulations from 2006. Again, I'm not going to go into loads of detail about what is required under TUPE on this webinar. There is more information available on our website. However, TUPE generally aims to ensure continuity of the terms of employment as the employees move across from one employer to the other. There are obligations on both parties under the TUPE process, and failure to comply can result in claims being made by employees. So it's really important to make sure that that is properly covered. I would pull in one of my employment colleagues to particularly advise on that to make sure that the process is properly covered. That is basically a bit of a summary about selling your business. I hope you find it useful. It is a significant transaction. There is potentially a lot of money at stake, and it's vital that the proper procedures are therefore followed. They protect you as much as anything else. It's also important to note that it will take up a lot of your time. It can therefore be a very stressful time. You're trying to deal with questions from your lawyers, questions from the buyer. You're trying to get your head around long, complex and unfamiliar documents, and all the while you're trying to continue to run your business and make sure that the profits don't dip.
Liz, I think this is where it's actually really important to note that, you know, getting the right team around you is really key for this sales process. If you've got a lawyer on your side that's making a meal of every single document that's coming through from the buyer and is nitpicking over every single aspect of the deal, it may end up getting you a couple of extra pounds at the end of the deal, but the length of time that it's taken and the amount of the seller's time, your own personal time, which is obviously that's the one thing you are very short of when you're running a business, having that nitpicky lawyer really can at least slow down a deal, if not completely scupper it. And I always try to work with lawyers that have got a bit of a practical sense, someone like yourself that can look at the deal and say, well, yes, we could go into detail about these two words that they've got round the wrong way, but it doesn't really matter. Let's look at the practicalities of the deal. Let's get this thing through. And I think it's really important that, you know, not only you work with the right lawyer, but you work with a lawyer that's going to be practical as well as, you know, obviously clever and understands the law.
Thank you, Roger, and obviously I would entirely agree with you on that. And in the same way, I'll return the compliment. I would agree, you know, having a practical tax advisor, having your accountants is also, as we talked about earlier, having that right team around you on board, and hoping that the other side also has a similar team, because there's nothing worse than coming across a lawyer who maybe doesn't fully get the process, doesn't do this on a daily basis, or like you say, goes the other extreme and really gets down to too much nitty-gritty and disrupts the overall flow of the process. So I would completely agree with you there. Hopefully, therefore, this webinar has given you all a little bit of a sense of what's involved, and ideally some of the preparation that we advise you to carry out before you get ready for a sale. If you have any questions about anything that we've discussed today, if you would like any further information on any part of the process, please feel free to get in contact with either of us. As I say, our contact details are available at the end of this webinar. But for me in particular, thank you very much for your time.
Thanks, everyone.